In the span of 48 hours, a market that prides itself on being liquid, orderly, and predictable revealed something it is not supposed to reveal. Gold did not merely rise or fall. It behaved as if the pipes behind the price were being squeezed. The official numbers said one thing, the physical behavior said another. $261 trillion, roughly 728,512 bars. And yet China's domestic market could still behave like access was being rationed. They said this could never happen. They said a market this large could absorb anything. They said price is the truth. But price is only the headline. The truth is the pipeline. And when the pipeline is managed, the market can look normal right up until it doesn't. Here is the uncomfortable idea that changes everything. The gold market is not a single market. It is a chain of permissions, locations, and settlement rules. The price is a headline. The pipeline is reality. When the pipeline is open, gold behaves like a commodity. When the pipeline is throttled, gold behaves like a rationed asset, and rationed assets create premiums, distortions, and sudden repricing moments. Institutions already know this. Most people never see it because the chart does not show who's allowed to move metal, how fast, and under what terms. That is the information asymmetry. The gatekeepers see the flow. Everyone else sees the story after the flow changes. And what I'm about to lay out is not opinion. It is pattern. It is mechanics. It is the difference between stock and access. It is the pipeline story that changes everything. Welcome to the Flow Ledger, where we decode what matters before it becomes headlines. If you like calm data-first analysis that connects the dots without the noise, you're in the right place. Subscribe if this is the kind of signal you want more of, and leave a comment telling me where you're watching from, because gold looks very different depending on whether you live near the vaults, near the refineries, or near the buyers. Now let's talk about the event that brought this pipeline story into focus, with specific dates, specific numbers, and specific institutions. China is not a place where gold imports are simply the result of private demand meeting global supply. The intake valve is administrative. Import quotas are allocated, and only certain banks with the right licenses can bring significant amounts of bullion into the country through the formal channel. That means the flow can be increased or decreased without a single mind producing more or less. And when the flow is controlled, the domestic market can detach from the international market, even while the headline global price looks calm. On April 14, 2025, reports indicated that the People's Bank of China allocated fresh gold import quotas to some commercial banks. Pause on what that implies. It implies there was demand pressing against a constraint. It implies there was enough tension in the system that the gate needed to be adjusted. And it implies that anyone analyzing gold without watching the gate is missing the most important variable. To understand why that matters, start with the flow numbers that frame the period. In December 2024, China's gold imports were reported around 84 tons. In the fourth quarter of 2024, total imports were about 270 tons. Across all of 2024, imports reached roughly 1,225 tons. That sounds huge until you place it in historical context. That total was about 14% lower than the year before and about 16% below the pre-COVID 5-year average, near 1,160 tons. In other words, the pipeline was still moving, but not as freely as recent history would suggest. Now look at the domestic draw on metal. In January 2025, withdrawals from the Shanghai Gold Exchange were around 125 tons. That number carries two messages at once. It was roughly 3% higher than the month before, suggesting demand was still present. Yet it was about 54% lower than the same month a year earlier, and about 37% below the 10-year average. That is not a clean story of demand collapsing. It is a story of a market functioning inside constraints, using inventories, recycling, and timing to keep the system moving. Here's where it gets interesting. When imports are lower than the recent norm and withdrawals remain meaningful, something has to give. Either inventories are being run down, or other sources of supply are being tapped more aggressively, or premiums rise to ration demand, or policymakers adjust the flow. The April 2025 quota reports fit that last category, a controlled release of pressure. This is also where contradictions multiply, because the gold story is never only about jewelry demand or retail bars. It is also about reserve management, geopolitical hedging, and trust in settlement systems. Analysts have pointed to a significant discrepancy between what China's central bank publicly reports and what some infer through trade flows and safe channel estimates. In one telling comparison, public reporting suggested roughly 25 tons of official gold added in a year, while some analyst estimates implied something closer to 250 tons through channels that would not necessarily show up in the way casual observers expect. That gap is not a rounding error, it is a fog. And in fog, you stop trusting the horizon, you start trusting the instruments. Now step back and ask the bigger question. If London reports thousands of tons in vaults, why would China ever look locked out at all? The market is full of gold in aggregate. The market can still be tight in deliverable form in the right place at the right time. To see how this happens, you have to understand the structure. On the western side, London is a hub for over-the-counter bullion trading and vaulting. COMEX in the United States is a futures market where most contracts never end in delivery, but the delivery mechanism still anchors perception. On the Chinese side, the Shanghai Gold Exchange is a domestic center of physical link trading and delivery. Between these hubs sits a chain: refineries, shipping logistics, insurance, customs, and crucially, permission. Permissions are the underrated variable. A refinery can produce bars, a ship can move cargo, a vault can store metal, but if the administrative gate is narrow, the flow is still narrow. That is why quotas matter. They are not a side detail, they are a control knob. This pipeline logic is not new. Markets have always broken at the point where promises meet constraints. In 1968, the London Gold Pool arrangement could not hold a fixed price against physical demand and official selling limits. The system fractured and the price regime changed. In 1971, the United States closed the gold window, ending convertibility, because foreign claims were pressing against limited reserves. Again, it was not a commentary. It was a mechanical failure of a promise. In 1999, a surprising policy signal around central bank sales shifted expectations and liquidity, and the market responded violently because positioning was built on an assumption that the official sector would behave predictably. In each case, the pattern rhymed. First, stress appeared in the mechanics. Second, narratives lagged. Third, the market repriced what it thought it understood. The key is that the trigger was rarely a dramatic announcement. It was the moment when the system's implied guarantee met the system's actual capacity. Today, the control system is not convertibility. It is access, it is deliverability, it is the distinction between paper claims and physical settlement pathways. Paper can be created instantly, physical cannot. The bridge is the pipeline, and bottlenecks in that bridge create dislocations. Let's name the players, because this is where institutional movement becomes visible. The People's Bank of China sets the tone through quota policy and reserve signaling. Commercial banks with import licenses execute the permitted flow. The Shanghai Gold Exchange provides the domestic venue where physical demand expresses itself in withdrawals and delivery. In the West, bullion banks intermediate between clients and the London vault system, while futures exchanges provide hedging and speculative leverage that can multiply paper exposure without multiplying physical inventory. When those institutions move in coordination, it rarely looks like a conspiracy. It looks like timing. A quota allocation happens after local premiums rise. A bank widens a spread. An exchange changes delivery incentives. A set of actions that look unrelated begin to rhyme when you align them on a calendar. And the calendar matters, because the market does not reprice when a trend is obvious. It reprices when the next marginal unit cannot be sourced under the expected terms. That is why a quota headline can matter more than a macro headline. It is a clue about marginal availability. Now consider the dislocation in plain language. London's reported vault tonnage can suggest stability, even abundance, yet China's domestic market can exhibit tightness that forces policy action. Those two statements can both be true because the vault number is an inventory snapshot, not a flow guarantee. A city can have full reservoirs and still have dry taps if the pipes are restricted. A warehouse can have stocked shelves while one neighborhood has shortages if the roads are blocked. Gold is the same. The where and the when are everything. This is why the phrase locked out should be understood carefully. It does not necessarily mean China cannot buy gold at all. It means the formal pipeline is gated, and when demand surges, the gate becomes visible in the form of premiums, withdrawals, and quota adjustments. Let's bring the numbers back in, because numbers are where storytelling becomes proof. Imports, about 84 tons in December 2024, about 270 tons in Q4 2024, about 125 tons in 2024. Withdrawals, about 125 tons from the Shanghai Gold Exchange in January 2025, with a slight month-to-month increase but a steep year-to-year decline and a below-average reading. Vaults, about 906 tons in London at the end of December 2025. Policy action. Fresh quota allocations reported on April 14, 2025. And the reporting contradiction, 25 tons publicly reported versus estimates near 250 tons through less visible channels. These are not random facts. Together, they form a map of stress. The map says the global inventory picture and the local access picture are diverging. When that happens, the next step is almost always one of three outcomes. Policy widens the gate, price rises to ration demand, or the market finds a workaround route that changes where the metal sits. Now, let's talk about mechanism, because mechanism is where the pipeline story becomes understandable. The pipeline is managed through levers that can be pulled quickly. First is quota issuance. If quotas are tight, the domestic market can trade at a premium, and demand expresses itself by bidding up local prices relative to global benchmarks. Second is the rhythm of quota issuance. If quotas come in bursts, premiums rise into the burst and then soften after the burst, creating a cycle that looks like mystery volatility unless you know the schedule. Third is inventory behavior. When imports slow, the market leans harder on recycling, on drawing down existing holdings, and on shifting product mix toward what can be sourced domestically. Fourth is the behavior of intermediaries. Banks and dealers can tighten terms, adjust spreads, or prioritize certain clients when physical is harder to source quickly. Here's an analogy that makes it simple without dumbing it down. Imagine an airport with plenty of airplanes on the ground, plenty of fuel, and plenty of passengers who want to fly. But the control tower limits takeoffs per hour. The airport can still look busy, the runway can still look full. Yet passengers can be stuck because the bottleneck is permission, not planes. If the control tower increases the takeoff slots, the backlog clears. If it does not, tickets get expensive and people start looking for alternate routes. The pipeline is the takeoff slots. To make this even more tangible, consider what paper versus physical actually means in daily practice. A futures contract can represent 100 ounces of gold, or another standardized amount, and it can be bought and sold many times without a single bar moving. That is not inherently bad. It is how risk is transferred. But it does create a world where the volume of claims can dwarf the volume of metal that is ready to be delivered on short notice. Most of the time, that does not matter, because most participants settle financially, roll contracts, or offset positions. The system works because people behave as expected. The tension appears when behavior changes. When enough participants want immediate access to physical, or when enough intermediaries become cautious about their ability to source metal quickly, the system's assumptions are tested. And because the system is built on smooth settlement, even a small change in preferences can create outsized effects in spreads. That is why physical tightness often shows up first as small oddities. A local premium that refuses to go away, a surge in coin and small bar demand, a sudden willingness to pay more for immediate delivery than for future delivery, a tightening of terms by intermediaries who normally compete aggressively. These are not dramatic on a chart. They are dramatic in a vault ledger. The same logic applies to quota-gated imports. If the shipping lanes are open, the vaults are stocked, and refineries are running, but a country's formal intake is capped, then local demand will express itself through whatever channels remain. It might pull down existing inventories. It might accelerate recycling by offering better prices for scrap. It might move demand into products that can be sourced domestically. It might appear as quiet accumulation that does not show up in the obvious monthly totals. Over time, however, sustained demand tends to force a choice. Accept higher premiums, widen the gate, or tolerate growing distortions. That visibility often comes through one signal, an abnormal spread that persists. A spread is the market's way of pricing a blockage. Friction can be shipping, refining, insurance, or law. In China's case, a meaningful portion of that friction is administrative. Now zoom in on why institutions care so much. A bullion bank does not just look at the headline gold price. It looks at how easily it can source bars in one location, transform them into the right format, and deliver them into another location. It looks at how long it takes, how much it costs, and what could go wrong. A central bank does not just look at price. It looks at settlement reliability under stress. That is why a managed pipeline can be attractive to policymakers. It can smooth domestic conditions, even if it creates periodic dislocations. Both are describing different layers, the stock layer and the flow layer. The moment those layers collide is when you get the kind of repricing events that people later describe as sudden, even though the signals were present in spreads and policy actions for weeks. If you want a simple checklist of what to watch, think in terms of gates and pressure. Gate indicators include quota allocations, licensing changes, and any official commentary about import management. Pressure indicators include persistent local premiums, strong exchange withdrawals relative to recent norms, and any signs that the market is pulling from inventories faster than it is replenishing. When gates open, while pressure is high, flows surge. When gates stay tight while pressure builds, something else has to absorb it, either through price, substitution, or workaround routes. And that brings us back to those 48 hours. The point is that it reveals the control system. It tells you the market is not in a simple equilibrium where everyone has equal access. It tells you the pipeline is being actively managed and that management can change quickly. When management changes quickly, prices can change quickly. Now, what does this mean forward in a way that respects uncertainty but uses history? Historically, sustained dislocations do not persist forever. Either the system adapts or the price adjusts. The conservative scenario is that the pipeline remains managed and premiums pulse with quota cycles. The moderate scenario is that repeated quota expansions pull more metal through the pipeline, tightening the global physical market over time, even if paper markets remain liquid. The aggressive scenario is a discontinuity, a moment when paper claims and physical availability diverge enough that the market reprices the convenience of immediate delivery. You do not have to predict which scenario occurs to be ahead of the narrative. You just have to watch the right indicators. Watch the frequency of quota allocations and any hints of broader licensing changes. Watch domestic withdrawals and how they compare to import throughput. Watch for persistent premiums, not one-day spikes. Watch for changes in exchange rules that alter delivery incentives, because rule changes are often a response to stress. Watch for the behavior of large institutions around those signals, because institutional timing is rarely random. This is the part no one wants to admit. Markets are not always priced by the average unit. They are priced by the marginal unit. The marginal unit is the last bar available under the expected terms. When that marginal unit becomes hard to source, the system can appear calm right up until it does not. That is why the pipeline story changes everything. It tells you where the stress accumulates before it appears as a price move. It also explains why the public conversation gets trapped in false arguments. Both can be right, because one is describing stock and the other is describing flow. Stock is inventory, flow is access. In tight moments, access is the market. This leads to the final uncomfortable point. The real divide is not between optimists and pessimists. It is between those who track the plumbing and those who track the poster. People who only watch the spot chart will be surprised when a small administrative headline moves the market more than a major economic release. People who watch the pipeline will understand that the headline was not small. It was a signal that the gate was moving. Institutions move first because institutions live in the plumbing. They see the applications for quotas. They see the premium behavior in real time. They see the settlement terms and the inventory constraints. Retail moves last because retail has told the story after the flow has already shifted. That information gap becomes a timing gap. And timing is where outcomes are decided. So when you hear China locked out of gold, don't treat it as a slogan. Treat it as a question. Locked out by what exactly? Locked out by global scarcity or locked out by a controlled pipeline? The data points we walked through point to the second. The pipeline is the story. The gate is the story. And when a gate controls flow in a market as symbolic as gold, every quota allocation is more than a bureaucratic footnote. It is a message about how the system is managing pressure. This is the flow ledger, where we decode what matters before it becomes headlines. If this helped connect the vault numbers, the import numbers, the withdrawal numbers, and the policy numbers into one coherent picture, you know what to do. Because the question isn't whether the next chapter becomes obvious later. The question is whether you're watching the gate while it still looks invisible.